Good morning, hunters. Welcome back to the Daily Hunt for Multi-Baggers on this Wednesday, April 22nd, 2026. We've got a really interesting batch of insights from yesterday's social media chatter and market data.
Absolutely, Ethan. Our AI systems crunch through a significant number of posts, flagging a diverse array of companies today. We're seeing everything from soaring tech giants to intriguing consumer brands, but also some with underlying risks that are definitely worth a closer look.
That's right. The overall market sentiment seems to be a real mixed bag. There's a lot of bullish energy around certain growth stories, but also some serious caution being thrown around, especially when it comes to valuations. It's going to be a fun one to break down. Let's jump right in with a name that's been making a lot of noise: Reddit, symbol RDDT. We've seen a ton of bullish sentiment. Users are predicting it could go to $300, even $700. They're saying numbers go brr and are really hyped about its unique market position, early monetization, and strong revenue growth, nearly 70% year over year. Plus, insiders have been net buyers, which is always a good sign.
Hold on a minute, Ethan. While that 69.7% revenue growth is indeed impressive, and insider buying is a positive signal, we can't ignore the very high PE ratio of almost 60. The market is pricing in a lot of future growth there. More critically, the user complaints are overwhelming. We're talking about pervasive bots and AI posts, censorship, power-tripping mods, and users saying the platform is cooked and they hate this site and want it to die. That kind of user dissatisfaction, coupled with news of disappointing user engagement growth, is a massive red flag for a social media company. Previous ratings for RDDT have mostly been stay away or speculative gamble.
Yeah, I get that, Brooke. The user experience issues are concerning, but the financial metrics now are strong, and analysts are initiating buy ratings with targets up to $200. They see the weak 2026 performance as an opportunity to buy. It's a classic growth stock scenario where the early monetization could drastically change things.
Potentially, Ethan, but those qualitative issues could seriously impact long-term revenue growth and user retention. It's a high-stakes bet. For now, given the extensive user dissatisfaction against a high valuation, my AI-generated insights suggest we stay away from RDDT.
Fair enough. Next up, let's talk Poet Technologies, symbol POET. We've seen some users calling themselves poets and talking about this company being a supplier to hyperscalers, expecting 3 to 5 times returns. One even predicted $100 by the end of the year. They've had a solid 182% run, and insiders are net buyers here too.
Optimism is great, Ethan, but the fundamentals tell a very different story for Poet. The company is currently unprofitable, with negative EPS of negative 0.68 and zero net profit margin, yet it has a $1.5 billion market cap. That disparity, with such low revenue, suggests the stock is heavily speculative. Also, that debt-to-equity ratio of 3.845 is quite high for an unprofitable company. While news mentioned them clarifying PFIC status and addressing a short report, which can provide a temporary bounce, it doesn't solve the core profitability issue. Previous ratings have consistently been stay away or speculative gamble.
But the insiders are buying, Brooke, and they're making strategic shifts which could lead to revenue and profit growth down the line. It's about seeing the future potential.
It is, but the current KPIs don't support that future yet. Betting on potential without a clear path to profitability, especially with that debt, is a very risky proposition. My AI-generated insights lean towards caution. We should stay away from Poet.
Okay, moving on to a heavyweight, Advanced Micro Devices, AMD. This stock has been on an absolute tear. Users are celebrating a 40% rip in a month and it hitting record highs. People are calling it the second chance to earn massive AI gains if you missed NVIDIA. That's pure growth potential, driven by AI. Plus, insiders have been net buyers, nearly 6.5% of their total holdings.
It's had a rough few stay-away ratings in the past, but has recently seen some buy ratings. It's true, AMD's run has been incredible, Ethan, and the 34.1% revenue growth is very strong. The insider buying is also a strong signal of confidence. But we have to look at that PE ratio. It's a staggering 108.58. That means the market has extremely high expectations, and any miss on their upcoming earnings on May 5th could lead to a significant correction. Also, the debt-to-equity ratio is quite high at 6.359. That's a lot of leverage.
I hear you on the high PE, Brooke, but the PEG ratio, which factors in growth, is a favorable 0.82. That suggests it might actually be undervalued relative to its growth prospects, especially in the AI sector. The market is clearly anticipating continued strong performance.
A low peg is definitely a strong point, but the leverage and the sky-high PE still mean it's a volatile ride. For investors comfortable with that risk, I'd say it's a strong contender. The AI insights and consistent insider buying are hard to ignore. For me, given the momentum and AI narrative, it's a buy for those with a long-term view. Next up, Birkenstock, symbol BERK. Users are talking about strong customer loyalty, expansion into new markets, and a resilient brand. Analysts have upgraded it to buy, and insiders are increasing their ownership. It sounds promising. This is a first-time mention for BERK on our show. It really does, Brooke. The post highlights an anticipated bounce back in consumer spending, an attractive forward PE of 14x, and projected 18% constant currency growth for FY 2025. They're easing tariff pressures and seeing strong institutional interest. It's a classic luxury growth story with a loyal customer base. All good points, Ethan, and the current PE ratio of 17.53 certainly looks reasonable, especially if that forward PE materializes. But there's a significant red flag in the KPIs, an exceptionally high debt-to-equity ratio of 48.637. That's a substantial amount of leverage, which introduces considerable financial risk, especially if the projected growth doesn't fully materialize. While the operating margin is healthy at 19%, that debt level is something to monitor very, very closely.
The upcoming earnings on May 13th will be crucial to see if they deliver on those growth projections and if they discuss managing that debt. But with the brand strength and market expansion, I'm optimistic.
I'll acknowledge the strong brand and insider confidence, but that debt figure makes it a very cautious proposition for me. However, the analysis leans towards a buy given the other factors. So I'll agree it's a buy, but definitely with an asterisk for that leverage. All right, let's talk Hims and Hers, symbol HIMS. People are buying the morning dip and saying the Dick and Hair Growth Pill Company isn't going away anytime soon. There's strong confidence, and users are calling it a smart buy because it's been on a tear. Plus, there's been massive insider buying, over 60% of total insider shares purchased.
Yes, Ethan, the 28.4% revenue growth and that significant insider buying are compelling. But let's pump the brakes on the enthusiasm. Hims carries an extremely high debt-to-equity ratio of 207.161. That level of debt is profoundly risky, and that high PE of 58.35 means it's priced for perfection. The news about Amazon launching a competing weight loss drug program is a massive competitive threat that could wreck all of Hims and Hers' upside potential. The previous 52-week high of $70 might no longer be a realistic target if Amazon seriously impacts their market share. Previous ratings have almost consistently been stay away or speculative gamble.
But they're actively building a scalable platform and have innovative pipelines. That insider buying shows they believe they can navigate the competition. Dips are for buying.
Even for a dip, the fundamental risk from the debt combined with a new, formidable competitor like Amazon makes this extremely precarious. Until we see clear evidence they can fend off Amazon without eroding margins or deepening their debt hole, my AI-generated insights suggest we stay away from Hims.
Okay, shifting gears to Opendoor Technologies, Open. We only had one mention, but it was a positive one, recalling Open as a multi-bagger opportunity back in 2025. And look, there's been substantial insider buying, 10% of total insider shares purchased. That's a strong vote of confidence from within the company.
A historical multi-bagger is interesting, Ethan, but we need to look at current reality. Opendoor is bleeding cash. We're talking negative revenue growth of 32.1%, a net profit margin of negative 29.7%, and an EPS of negative $1.73. On top of that, the debt-to-equity ratio is astronomically high at 131.343. That level of debt for an unprofitable company is a giant red flag. Previous ratings have almost consistently been stay away. But that insider buying, Brooke, they must see a path to a turnaround, maybe with the upcoming earnings on May 7th. They're making a bet on future improvements. Insider buying is compelling, but it's not enough to offset such dire financial health. Until they demonstrate a real path to consistent profitability and significant debt reduction, the risks are just too high for the vast majority of investors. My AI-generated insights tell me to stay away from Open.
All right, next up is MIGC Investment Corporation, MTG. The original post was bullish about strong growth and larger collaborations for Magic the Gathering. And get this, insiders have been buying like crazy, nearly 30% of total insider shares purchased. That's a huge vote of confidence, and the PE is super low at 8.91, with a peg of 0.4.
Ethan, while those valuation metrics and insider buying are impressive, the user sentiment is overwhelmingly bearish on the long-term health of Magic the Gathering. Users are complaining about player fatigue, overprinting, and non-stop set releases ruining the game. They say products are sitting on shelves and that the company is sacrificing long-term customers for short-term one-off buyers. The revenue growth is actually slightly negative at minus 0.9%, which aligns with these complaints. And that debt-to-equity ratio is still quite high at 12.552. This is a first-time mention for MTG on our show.
But the analysis suggested buy because of that strong insider confidence and attractive valuation. They must be seeing something in those numbers, maybe expecting a bounce back or new strategy to pay off.
The upcoming earnings on April 29th will be critical to see if their actual sales can counteract that player dissatisfaction. For now, the strong insider confidence and low valuation metrics against the backdrop of significant user concerns make this a very mixed bag. I'd label it a cautious buy, but definitely one to watch closely. Finally, let's discuss UnitedHealth Group, UNH. The news is incredibly positive. They significantly beat Q1 earnings and revenue estimates, raised their 2026 EPS guidance, and the stock surged 7 to 9%. They're even focusing on AI for future growth. Users were discussing playing the earnings, and frankly, the market reacted very well. Insiders have been net buyers too. The earnings beat and raise guidance are definitely excellent, Ethan, and the focus on AI is a smart long-term play. But we also saw news questioning if the stock has surged into overbought territory. While the fundamentals are strong, 12.3% revenue growth and a reasonable PEG of 1.15, the PE is still a bit high at 26.15. And the debt-to-equity ratio of 81.618 is something to keep an eye on, as it's a significant amount of leverage for a company this size. Our AI-generated insights specifically warned about short-term speculative trades immediately after a large jump. UNH has sent a few stay-away ratings recently, but also buy previously. I agree on caution for short-term trades, Brooke, but the underlying company strength is undeniable. The market reaction shows conviction, and the AI focus signals future innovation. For long-term investors, this looks very solid. Given the strong earnings performance, improved guidance, and strategic direction, the underlying fundamentals suggest a strong company. So despite short-term trading warnings, my AI-generated insights suggest a long-term buy for UNH. All right, let's quickly recap our top picks for today's deeper analysis, based on our AI-generated insights. Investigate as buy, Advanced Micro Devices Inc., AMD, UnitedHealth Group Incorporated Common Stock, DE, investigate as cautious buy, Birkenstock Holding plc, Ordinary Shares, BIRK, MIGC Investment Corporation, MTG. Investigate as speculative gamble, Reddit Inc., RDDT. And that wraps up another episode of The Daily Hunt for Multibaggers. This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset. Thanks for tuning in, everyone. We'll be back tomorrow with more AI-generated insights to help you navigate the market. Happy hunting!